Are you an American investing in UK real estate via a limited company? Wow, you're in trouble and you're guilty as charged. Hi, my name is Simon Misiewicz from Optimise Accountants, and unfortunately you are guilty as charged. In this video I want to talk to you about the recent tax changes that's going to affect your US tax position if you are a US citizen investing in a UK company that in turn invests in any type of trade or real estate investments. So let's get into the detail of how guilty affects you as a US citizen. Alright, so let's get into the detail now of why I feel that you as a US citizen should not be holding shares of a UK company of 10% or more because of Gilti. Alright, so let's talk about Gilti, what that is. But before we do that, there are a couple of videos that I think you should enjoy. The first video is the tax difference between the UK HMRC and IRS, US state tax. There are so many differences between the two tax systems that I think you should be aware of before you get even into the detail of Gilti. So make sure you watch that video. And I've also got an example now of real estate that you are taxed in the UK and how indeed that is transferred over to your 1040 US tax return. So I do think you need to look at both of those videos whilst maybe watching before or after this slide deck. I now want to talk about then Gilti and what is it. This is for those that are owning shares in the personal name of a CFC, which stands for Controlled Foreign Corporations, which to me is a UK company. Now you may have companies, CFCs all around the world, but clearly we always just focus on the US tax and the UK tax position. And a controlled foreign company or controlled foreign corporation like this could affect you in terms of Gilti. And to do that, I want to kind of give you a picture of why in the past people have used limited company structures here in the UK. To illustrate that, I've provided you now with a tax position if you owned any type of trade or real estate property investments in your own name. And you'll see that if you've got earnings of £150,000 or more, you're unlikely to be subject to this 45% income tax rate, which is huge. I mean, if you compare that to the US tax, it's a lot more than you pay. And to be fair, probably overkill in the UK right now, but that is what we are subject to. And that's why people use the corporation tax, a corporation structure, because they benefit from the lower corporation tax rate. Right now, we're at 19%, but if you're watching this video in April 2020 and beyond, then you should be in the knowledge that the corporation tax rate is 17%, which is a lot less than what we ever expected, in all honesty. Which is, again, is actually going to be less than US corporation tax rate, so which is great. However, IRS not happy. They are not happy at all. So even though you've saved tax from using a tax efficient UK structure, IRS not happy at all, and they want to go for you in terms of your tax position in the US. Before we get into that detail, if you are using a UK limited company and you want to make tax efficient withdrawals, then you want to watch this video, which should be appearing above my head right now, of how to extract cash in the most tax efficient way. So go ahead and watch that video. All along this video though, you are going to have questions, so make sure you type in your questions below this video and I will get back to you as soon as humanly possible. So I've created an online portal where it'll help you to understand how you can save SDLT when you're buying a property, value added tax when you're buying a commercial building or indeed refurbishing a property, the income tax and corporation tax that you can save when making profits on your property portfolio. So make sure you enroll today and start learning how you can save tax on your property portfolio. Okay, so now we're talking about Gilti. which stands well, guilty as charged, as I said on my introduction video, which I find is a disastrous title to give it. Guilty. I mean, talk about making people feel targeted. I mean, why not just say guilty as charged, full stop? But guilty stands for Global Intangible Low Taxed Income, which is a bit of a mouthful, I have to say. And it's part of the Section 951 foreign tax credit, which you need to take into account. But ultimately, the guidance that you're seeing on the screen can be read by your good self. So if you want a bit more detail, there is a link to a PDF document with this URL that I'm showing you now, and it contains a document of 300 plus pages. So if you want to if you have problems sleeping at night, I suggest reading that document, because I guarantee within 20 pages long, you'll be fast asleep. So watch this video if you want an abbreviated version. But we need to come back now and talk about, well, where did guilty come from and why is it here? Ultimately, guilty was to stop people from making tax efficient structures around the world. I'm not going to mention any companies right now, but you can probably fathom that out yourself. So guilty was introduced, part of Tax Cuts and Jobs Act in 2017. It is implemented from the 1st of January 2018. So do you have to rebase your 1040 tax return given this information? Who knows? But Gilti Tax is a complex formula, which I'm going to go through an example on this video. So hopefully it will bring to light how it could affect you, and indeed how you must use the calculation as well. This also suggests that individuals taxed in the US, even if no distribution has been made. So get this, you've already been taxed in the country that you are. Here we're talking about the UK. You've made no distribution, but the US IRS want to tax you on something that might happen in the future. Not what will, but something that might happen in the future. So guilty is about a tax charge that is going to affect your company profits in the UK, even though no distribution has been made, which is scandalous. IRS have provided you on their website with a formula bar, if you like, so you can work out your own guilty, which even now when I'm saying guilty, I'm astounded by the fact that they would even dare say guilty. Surely someone in their PR department would have said, maybe we should change that, don't you think? But anyway, we are where we are, and they've given you a formula of how guilty can be calculated. Clearly, this is quite complex, so without an example, you could be left overwhelmed. And that is why you might have a headache. So this presentation might be called your pill of releasing that headache. But all the way through, if you have any questions, then make sure you type in those questions in the comments box below so I can help you and guide you through the right solution. So now let's go on and go for the guilty example. Here, there is something called a real estate property value. So you may have a company, and because we're focusing on real estate property investors, this is very, very relevant. So you could have a property value of $200,000. You'll notice I've already converted it to dollars, so it kind of makes it easier for you to understand this. But you've got a property value of $200,000. The IRS do give you a tax credit of 10% of the qualifying business asset investment, which is QBI. Actually, that's a better name, isn't it, than guilty? QBI is a 10% credit based on the real estate property investment. Now, to be fair, it doesn't need to be just real estate. It could be other plant and machinery, other buildings that you have that generates a income stream for your company. So if you've got a trade company, you need to value up all of your other assets as well. But because we're focusing on real estate, it makes it easier for our calculations today. So you'll notice that there's a Section 962 election that may be claimed. Why might you do a 962 election? Well, basically it means I declare my income, but I wish to be taxed in the US at corporation tax rates of 21%. and not income tax rates of 37% or even more. But ultimately, what we're trying to do is show you the options in which you can mitigate the problems of Gilti. So we've got two examples here. We've got a UK corporation held in your personal name as a US citizen. We've also got an example whereby we've got UK corporation but owned by a US corporation. So it could be a C corporation, if you will. So what we've done, we've given you two exact examples. One, shareholding in your own name and shareholding in your corporation in the US. And you've got this net profit after tax of $50,000, which is from the UK trade, the trade investment company, and you get this QBI of $20,000. So you've now got this Gilti charge of $30,000, which is subject to tax. The Gilti is not the tax itself; it's what is subject to tax. So that's relevant for the next slide, because what we're trying to say is the Gilti tax of $30,000, we do get this released. Now what I'm going to do is just highlight it here. So this is the $30,000 that we've already covered off in the previous slide. But because you're using a corporation structure in the US, you get the $15,000 credit. So reduction, but you'll notice that there's no reduction there at all. You will be charged an income tax rate in the US based on that $30,000, which heck of a lot of money right there. But if you're using a company structure in the US to hold your company structure in the UK, you get this 50% Gilti reduction. So this is now subject to subject to 21% corporation tax, which gives you a tax rate of £3,150. Now, if you look at this £30,000, which will flow down to your income tax levels, you bet you're going to be paying a lot more tax in the US. It could be £10,000, right? Based on 30-odd%. So that's straight away more money than you would pay in a corporation tax structure. So even more reason for you to think about it. It gets better if you own a UK company in a US tax structure because of this scenario. In here, we've got this Gilti chargeable of $15,000, which remember is a $30,000, but you get half of it reduced. So that means your Gilti charge for a corporation is $15,000, but you get this foreign tax credit of 19%, which is the UK tax rate currently. Of 2850. So that 2850 is a tax credit, but you get a limit. So they say you can have the tax credit, but they do caveat that by saying you can only have 80% of that tax rate, and therefore you can have 2,280 as a reduction. How does that really work in total? There's a lot of numbers, I do appreciate. But what we're saying here is that you've got now in the US, using a corporation tax structure, you are going to be subject to 15,000 Gilti, which is subject to tax. You've got the tax rate of 21%, which is now going to give you a tax bill of $3,150. But you do have this tax credit, this foreign tax credit of 2280, which gives you now a tax liability of 3870, which compares to $10,000 if you had that UK corporation held in your personal name. $10,000 versus $870. Which one do you prefer? This kind of tells you that you ought to be thinking about incorporating your shareholding from your own name and passing it on to a corporation structure in the US to save you this amount of tax. But please do bear in mind that this is a serious amount of workings, which basically means you're going to be paying a tax preparer a lot of money to get this right. And if you've got a CPA in the States that doesn't understand the connotations in the UK, well, heck, you could be making a lot of mistakes along the way. So this is going to be adding a lot of money, which the IRS, I believe, has created an industry now just to create Gilti calculations for you, which is an absolute nonsense. But we are where we are. I think that's the truth of it. So if you have any questions, then make sure you type those questions in the comments box below, and I will do my very best to answer them. There are going to be so many nuances that I need to take into account. But if they're generic in reference, then I might be able to help you. So drop those questions in and let me try and answer them best I can. Now, what does this really mean for American citizens that hold UK investments in their own name? Or indeed, if they're going to hold it in a corporation structure but don't like what it means? Well, the first one is giving up citizenship. Now, this is an interesting one. So you are a US citizen residing and living in the UK, and because you have no intentions of going back to the US, you give up your citizenship, which basically means now you are going to be deemed domiciled in the UK, which means you're going to be subject to worldwide income for your tax liability. But not only that, when you pass away, did you realize that IHT, or inheritance tax, is at 40% in excess of £325,000? Now, I appreciate there are there are slight increases, maybe to £500,000 depending on your home value, but still, you could be subject to 40% inheritance tax in above that £500,000. And in the States, it's 11 odd million. It's a huge difference, right? So people do talk about, on other YouTube videos, talk about Gilti of saying, well, give up your citizenship and just live in the country you are. Well, that could be a ticking time bomb. So please don't do this without taking a great deal of time to understand the consequences of giving up your citizenship in the US. The second point here is use a C Corp to hold your UK investments. I think that's a given now. I don't think, even in the UK, we talk about people using a limited company structure because there's ways of using holding companies. You can transfer assets between UK companies in the most tax efficient way. I think what we're doing now is seeing the same kind of tax structure that's going to work beautifully in the US as well as it does in the UK. So we're going to now see a corporation tax structure for both countries, and I think we're going to see a lot of tax benefits because of that. We have got to think about the revaluation of property values from dollars to pounds and vice versa. So we need to think about foreign exchange rates and how that's going to affect your accounts in the UK, and then how that affects Gilti in the States. Right now, it could be bad. In the future, it could be worse. We've got this impact due to exchange rates, not only in terms of the calculation on your financial statements, but at the time that you pay the tax as well, the exchange rate could fluctuate. So you could be losing even more money. Do you now need to start thinking about creating options and buying options of different currencies? That could be a total nightmare, to be honest. But you do need to think about these implications going forwards. One of the main issues I have with this whole Gilti thing is that the UK based their accounts on IFRS, which basically stands for International Financial Reporting Standards. Okay, so we base our accounts on one format, but in the US, well, that's not true. You have to base your accounts on US GAAP, which is a major difference when you're holding stock. So what does that really mean? You've got more compliance work. Oh yes. So you've got to convert the UK profits, convert it to US exchange rates for currency, and then you need to change the valuation based on US GAAP to get this Gilti calculation going through. It is a complete nightmare. So if you've got stock, well, you might need to reconsider what you're doing in your business, because this is going to hurt, and it's going to hurt a great deal. If you're a real estate investment holder, is it going to be affecting you too much? Well, maybe, maybe not. You've got to look at your property valuations and see if the Q-buy that we talked about at 10% is at the right valuation for US GAAP purposes. So there may be something that you need to look at there, but not as much, as I said, if you hold stock. And that is a complete nightmare. If you liked what we've said, no, you probably don't. But if you feel that you need support with your 1040 US tax return and your UK tax return, then why not book a call to discuss our services? You could do so by using the link www.optimise.com optimizeaccountants.co.uk. Or indeed, if you just want 60 minutes of my time, you can upload your questions in advance. I will identify the best solution for you before the call even takes place. And then on the call, we talk about how you implement the very best tax structure for you. Again, you could do the same by using www.optimizeaccountants.co.uk, and you can use code U225 to get that 25% discount and talk to me for £300, which is a great deal of money to be saving you lots of tax. So ultimately, you've got to weigh up how much tax will it save versus the £300 investments, right? So I look forward to seeing you. My name is Misiewicz from Optimise Accountants. I'll see you again on the next video. Many thanks.